Make a video presentation of yourself reporting or discussing about the accounting cycle, including the following steps. First is analyze transaction. The accounting transaction analysis is the process of translating the business activities and events that have a measurable effect on the accounting equation into the accounting language and writing it in the accounting books. This is the first stage in the accounting cycle, which is the foundation of accounting regardless of the accounting type if you are interested in. Business analyze to ensure that the balance sheet equation say in the balance after each transaction is completed. In analyzing transaction, there are 6 steps of accounting transaction analysis. First is determine if the event is an accounting transaction. You first need to determine whether this transaction is a business nature transaction. An accounting also transaction has to involve a monetary amount. So if the company signed a rental contract, there is no accounting transaction. However, if it makes a payment under this contract, it will be an accounting transaction because it has a monetary amount that the company will need to record. Then the other examples include a purchase of equipment, sales of products, and salary payments. So number two steps in transaction analysis in accounting: identify what accounts it affects. Your next step is to identify which account the transaction will affect. For example, Ellen invested $38 in cash and a used truck with a market value of $8,500 in the business in exchange for the company's common stock. The cash and truck invested will be assets for that business, recorded under cash account and truck account. In exchange for that investment, Ellen will common stock, so it will also affect the common stock account. Then number 3, determine what type of accounts they are. An average transaction leads to a measurable change in the accounting equation. So knowing whether the account belongs to asset, liabilities, or equity will allow you to determine whether the account will have a debit or credit normal balance. In the example above, we already decided that 2 accounts will be assets accounts, and the common stock account is the owner's equity type account. Number 4, determine which account are going to up or down. A business record a transaction with an entry that has debit or credit effect. This double entry procedure keeps the accounting equation in the balance. So, when Ellen invested cash, the cash and truck accounts will increase because the company will now have more money and it now has a truck. The common stock account will also increase. So, number 5, apply the rules of debits and credits to these accounts. One has to record each business transaction in 2 or more related but opposite account. We debit one account and credit with the other account in the same transactions accounts. Then, accounts on the left side increase with a debit entry and decrease with a credit entry, while accounts on the right side with a credit entry and decrease with the debit. So, if the cash and truck accounts will increase and it is in assets account, the business will debit it. The common stock account is the equity account, which increases with a credit entry. Number 6, find the transaction amount to be entered into each account. Your final step would be determine the amount of transaction from the business records, such as our receipts, invoices, and bank statement. Next accounting cycle is the post-journal entries. Post-journal entries is the process of transferring recorded business events from the general journal to the ledger. In other words, posting is the next step in accounting cycle after journalizing. Then, what does post-journal entries mean? The first step in the accounting cycle starts by identifying events, analyze them to see how they affect the accounting equation. After events are identified, they can be recorded in the general journal with a journal entry. Then, these entries record the transaction effects on the accounting questions in the accounting system. Once the transaction is recorded, it must be transferred to the ledger accounts. This is where all of the journal entries recorded in the general journal are transferred into the individual account ledgers. You can think of the posting process like taking the journal entries and transferring them to T accounts. This way, we can total each account and keep track of its balance at all times during the year. An example, if accounting cycle didn't include the posting process, there would just be a big list of journal entries in the general journal at the end of account period, with no way to tell how much is in each account. Posting essentially organizes the journal entry or a journal into account balances. When each entry is posted its ledger account, the journal entry number is usually placed next to the entry in the T accounts. This leaves an audit trail or trying to follow back all the entries in the ledger back to the original entries in the journal. Next is an adjusted trial balance. To complete an adjusted trial balance, add the balances in the debit column and separately and those in the credit column, which respective total on the last line of the table in the appropriate column. The total debit column or debit balance should equal to the credit balance. So next is journal format. So to set up an adjusted trial balance, create a table and with the 3 columns in a sheet of paper or spreadsheet program. List the periods ending date above the table. Label the first column accounts. This column includes each account name in the general ledger. The second column is the debit column and shows the balance of the accounts with the debit balances. The rightmost column is the credit column, which shows the balances of accounts with credit balances. An account has either a debit or credit balance depending on the type of account. Using separate columns is useful for ensuring the total of all debits equals to the total of all credits. Reports accounting tool. Listing balance sheet account. The first accounts to include in the table are your assets, such as cash and inventory. These accounts have debit balances. After your assets come your liabilities, such as accounts payable and stakeholders' equities account, such as a common stock. Liabilities and equity have credit balances. Assets, liability, and equity accounts make up your balance sheet. For example, assume your journal ledger shows a cash balance of $40 less cash in the tables account column and $40 in the debit column. Below this include your assets, liability, equity, and accounts. Next is adjusting entries. In adjusting entries, there are 5 steps in accounting cycle and an important part of accrual accounting. Adjusting entries allow you to adjust income and expense to more accurately reflect your financial position. How to prepare your adjusting entries. Each adjusting entry will be prepared slightly differently. Here are examples on how to record each type of adjusting entry. Step 1 is recording accrued revenue. Anytime that you perform a service and have not been able to invoice your customer, you will need to record the amount of the revenue earned as accrued revenue. For example, John owns a cleaning service. He bills his client for amount of a service at the beginning of the following month. His bill for January is $2. But since he won't be billing until February 1, he will have to make an adjusting interest to accrue the $2 in the revenue he earned for the month of January. So, dara, naghimo na siyang table na ang date, then account, debit, then credit. Ang nakasuwat sa account is accrued revenue. So, ang gibutang niya sa credit, ang gibutang niya sa debit is $2. Then, ang ubos, account name na niya is revenue na. Then, dito niya gibutang ang $2 sa credit. Next, once John bills his client in February, he will have to make the following entry. So, ang date niya is 1/3/31/2020. Then, ang account name niya is accounts receivable. Ang account receivable niya is $2. Then, accrued revenue niya, dito niya gibutang sa credit, $2. The journal entry is completed this way to reverse the accrued revenue, while revenue entry remains the same. Since the revenue needs to be recognized in January, the month that was earned. Tips for accruing revenue. Accruing revenue is the vital for service business that typically bill client after work has been performed and revenue earned. Next is preparing an adjusted trial balance. Preparing an adjusted trial balance is the 6th step in the accounting cycle. An adjusted trial balance is prepared by creating a series of journal entries that are designed to account for any transactions that have not yet been completed. These items include payroll expenses, prepared expenses, and depreciation expenses. Here are the steps used to prepare an adjusted trial balance. Run an adjusted trial balance. This provides an initial summary of your general ledger account prior to entering any adjusting entries. Make any entries that are needed. Adjusted entries can include adjustment for prepayments, interest, and depreciation expense, and prior accruals. Run an adjusted trial balance. You can ensure that the entries have posted correctly by comparing the initial trial balance totals with the adjusted trial balance totals. Example of an adjusted trial balance is to understand what an adjusted trial balance is. We first have to view an adjusted trial balance as well as the necessary journal entries to complete in order to prepare an adjusted trial balance. So step 1, ang step 1 na niya, run an adjusted trial balance. So nara diri nakasulat diri ang account. Ang account na diri ang sa ubos mo ni ang mga sulti ang kaning account name, ang mga account name, example sa account name is cash, accounts receivable, prepaid rent, inventory, accumulated depreciation, account payable, notes payable, common stock, revenue, payroll expense, rent expense, depreciation expense. So, maghimutan ni dapat nabay adyoy ka ng debit o credit. So, first is cash. Sa kaning cash, nahimutan ni siya sa debit mo ni ang 10,000. Niya ang account receivable, sa debit niya po siya 7,000. Ano sa prepaid rent, 3,100 sa debit lang gyapon. Ang inventory 15,000. So ang kaning accumulated depreciation, accounts payable, notes payable, common stock, o ang revenue na belong ni siya sa credit. Ang kaning accounts depreciation is 5,500. Ang accounts payable is 10,000 sa credit jud siya. Ang notes payable 3,000. And common stock is 10,000 and revenue is 19,100. Then, ang kaning payroll expense, rent expense, utilities expense, depreciation expense na belong ni siya sa debit. 6,000 ang payroll expense, rent expense 3,000, utilities expense 1,000, and depreciation expense is 2,000. So, ang total aning duha, ang total sa debit ug ang credit is the same, 47,600. Baliin mo siyang i-add. The above trial balance is currently summary of all your general ledger accounts before any adjusting entries are made. Debits and credits should always match in the trial balance. Remember not to confuse an adjusting entries with closing entries. Closing entries are completed after the adjusted balance. Trial balance is completed. Step 2. Enter adjusting journal entries. So, naalang niya po ng account name, debit, and credit. So, ang rent expense niya is 700. So, then, ang prepaid rent niya is 700. Dili na himutang sa credit. Ang depreciation expense, 300 sa debit. Ang accumulated depreciation is 300. Dili sa credit. The above journal entries were made in order to account of depreciation expense and prepaid rent. So, step number 3, run an adjusted trial balance. So, nalangya po ng account, debit, and credit. So, ang account name na siya, nasod lang niya po niya ang cash, accounts receivable, prepaid rent, hantod sa depreciation expense. So, ang total niya kay December na 10,000, 7,000, 2,400, 15,000, there is debit. Then, ang total niya, 47,900. The same siya sa debit o credit. So, as you can see, by the adjusted trial balance example above, some of the accounts totals have now been updated. In this example, the adjusted trial balance shows the changes that affected both the rent and depreciation accounts. For instance, we expense rents for the month, so we needed to reduce the prepaid rent amount. For depreciation expense increased, while accumulated depreciation increased as well. In addition, your adjusted trial balance is used to prepare your closing entries, which is the next steps in the accounting cycle. Next is prepared financial statement. A financial statement is a formal record of a company's financial activity. This plans give a current landscape of your small business and forecast the future vision and plans of the business. Creating financial statements for your small business starts with your day-to-day bookkeeping. You will use, pull, and organize the data from this record to put together your financial statements. Your financial statements are the key part of a business plan that will help your business attract investors or obtain bank loans. Here are the types of financial statements and tips on how to create them. First is balance sheet. A balance sheet shows the assets, liabilities, and shareholders' equity during a specific period. To create a balance sheet, start by listing your assets on the left side on the page, including cash you have had in the bank, the value of the equipment you own, the value of the inventory you have in stock, and any other financial assets. On the right side of the page, list your liabilities, including accounts payable, credit card balances, bank loans, and any other money your company owes. Finally, total your assets and liabilities and then subtract your liabilities from your assets. The amount left is known as owner equity. Second is income sheet. An income sheet shows revenues, expense, and income or loss for a period. First, gather all types of earnings during the time period the statement will cover. The sources of earnings could be wholesale and retail sale or income for renting out priority or property. Next, total up the needs or expenses such as money spent on materials, payroll, advertising, utilities, equipment, rent, or business properties. Next is statement of cash flow. A statement of cash flow shows the inflows of outflows of cash and ending balance during a period. This statement of cash has flows, 3 sections: operating activities, investing, and financial activities. What should be included in a financial statement? A financial statement reports the financial health and activity to potential investors and creditors. So, this makes it easier for investor and creator to compare the financial health of your companies to other comparing financial statement. Therefore, it is standard practice to include these elements of your financial statement. First is assets. Second is equity, expenses, gains, investments by owners, liabilities, losses, revenues. These are the reports or these are the elements of the financial statements. And every business and accountant who prepares financial statement on a regular basis, management, creditors, and stakeholders use the statement to gauge the performance of the company and make projection about future results. These primarily financial reports are the profit and loss statement, balance sheet, and statement of cash flow. So though to say what this statement look like, start with the financial data from ABC Corporation. Using this information, you can figure out how to prepare several examples of financial statement. So sales is $3,200,000. Cost of goods sold is $1,920,000. And gross profit is $1 or $1,280,000. Ang administrative overhead is $875. Profit before interest and taxes is $405,000. Profit and loss statement. A profit and loss statement or income statement sums up a company's revenue, expense, and cost incurred over a specific period. It shows a company ability or inability to make a profit by increasing revenues or reducing cost of operations. The profit and loss statement is one of the reports that usually receives the most attention. After all, the goal of every business is to make a profit.